Good morning and welcome to RPC's Cash Balance Update. Our presenters today will be Wendy Frame and Jeremy Palm with Lurie. You have all been muted on today's call. However, if you have any questions during the presentation, feel free to submit them within the chat box. We will then answer during or after the webinar is completed. We also have a few poll questions in today's presentation, so be on the lookout for those throughout. As I mentioned earlier, we have Wendy and Jeremy with us today. They specialize in the administration and design of defined benefit plans, both traditional and cash balance, as well as support with ongoing technical advice. So with that, I'll turn it over to them.
Thanks, Alex. And good morning to everyone those that have been able to join us this morning. We're excited about talking to you about cash balance plans. And we're going to be looking at, what advisors should know as we think about cash balance plans for prospects and clients. So as far as the goals for the presentation this morning, we're going to look at what is a cash balance plan, who is a good candidate for a cash balance plan, how can they be used to improve your client's retirement and tax situations? And then what is your role as the advisor? So right off the bat, we jump into a poll question. Do you currently work with a client who sponsors a cash balance plan? Yes or no?
All right, I'll go ahead and close this. It looks like we have a 53% no.
All right, thanks for that, Alex. So yeah, so 50% or so yes, 50% no. Hopefully all of you will be able to get something out of today's presentation. We're going to go to the second poll question here. What do you think? Not expecting you to know the answer, but approximately what percentage of cash balance plans have less than 100 participants? A, 30%, B, 45%, C, 60%, D, 75%, or E, 90%. What do you think?
All right, it looks like we have about 67% saying E, 90%.
Well, smart group this morning. That is correct. E is the correct answer here. And I like to highlight this just to remind everyone that this tends to be the cash balance plan. It works best for companies that tend to be smaller. And so even most of these that are being put in place or I guess new cash balance plans, most of them tend to be put in place for companies that have less than 25 participants. So why do business owners put retirement plans in place? Just to kind of take a step back, I know today's focus is cash balance plans, but as a part of the cash balance plan discussion, we're going to be talking about, the 401k plan and, even the SEP. So typically the number one motivation, the business owner increases their tax deductible contributions by putting a retirement plan in place. It allows them to accelerate their retirement savings. And then as a third reason, attracting and retaining top talent. So, they may have some employees that they really want to hang on to, and they want them to stay at the company. A retirement plan can be used to keep those employees. From a deduction standpoint, the cash balance plan sits at the top. So at the bottom, from a limit perspective, you have IRAs and HSAs, and then as you move up the ladder to the simple, the limits increase, and then to the SEP and to the 401k. And then finally to that cash balance plan, we're going to be looking at what the limits are for a cash balance plan and how they are significantly higher than any of the other plans that you see here. Here's just a slide, and I don't need to highlight all of them, but to the right, the 401k plan, you can defer $19,000 into the 401k plan plus another $37,000 for a max of $56,000 for someone that is under age 50. And then if they are over age 50, they also get that $6,000 catch-up. So then you're looking at a potential max of $62,000 in the 401k plan. I just like to throw in this slide as we're talking about it. Sometimes I run into prospects as I'm talking about what they can do with a retirement plan, and these prospects are getting some misinformation. Hey, the SEP is the best that you can do based on your situation. I've run into situations where that is the information that the prospect received. The SEP is the most you can do, and so for 2019, $56,000 is the most you can contribute to a retirement plan. And then, I guess the good and the bad, I can come back to them and say, well, Mr. or Miss Prospect, you can actually contribute $200,000 to a combination of a 401k and cash balance plan versus that SEP alone. The other place where I think the 401k wins out over the SEP is that the business owner doesn't have to make as much money, and that deferral, that they can use the deferral in the 401k plan that gets them more than if they were just going to use a SEP. So just along the way, a point I want to make in the presentation today. All right, so this brings us to our next poll question. What is the maximum lump sum a business owner can roll over from a cash balance plan at age 62? And you see the options there: 1.3 million, 1.9 million, 2.3 million, 2.9 million, or 3.5 million. What do you think?
All right, it looks like we have about 40% of people saying 2.3 and 30% of people saying 3.5.
All right. And the correct answer in this case is actually D, that 2.9 million. So the big opportunity associated with a cash balance plan is that it provides a business owner with the ability to accumulate up to $2.9 million in a tax-deferred retirement plan at age 62. So it is a big opportunity for business owners, with the cash flow to fund the plan. And a question that often comes up is, okay, where is this $2.9 million coming from? Why is that the case? Well, if we think back to what I talked about with the 401k plan limits, that $56,000 or $62,000, depending on how old you are this year, the maximum annuity that a participant can be paid from a cash balance plan upon retirement is that $225,000 that you see there in Part A. And so the IRS has said, hey, in 2019, that's the most or the largest annuity that a participant can be paid. And so then we're simply taking that annuity and multiplying it by an annuity factor to come up with that maximum lump sum. And so that's where we're not pulling it out of thin air. That $2.9 million is just the lump sum value of the maximum annuity that a participant can receive from a defined benefit plan. Now here I'd just like to talk through or highlight, we've already looked at the 401k plan limits. If you're under age 50, the $56,000 is the most that you can contribute to a 401k plan. And then if you're 50 and above, that's $62,000. But on the right-hand side, the cash balance plan, you can see as the business owner gets older, the limits associated with the cash balance plan continue to increase. And so we'll talk about, who makes a good candidate later on in the presentation today, but you can see the older that the business owner is, the more opportunity they have to contribute to the cash balance plan. I guess that's the takeaway here, is that those limits are based on the owner's age, and then it's also a function of their compensation. So just a few basics on the cash balance plan. A cash balance plan is a specific type of defined benefit plan. The nice thing is that it looks and feels like a 401k plan. And then, we've kind of already talked about this, but the business owners can make much larger contributions compared to a 401k plan alone. And just to kind of dig into looking and feeling like a 401k plan, this is just a portion of a cash balance plan participant statement. And, I just like to point out, hey, it looks and feels like a 401k plan statement where you actually see, or a participant sees, an account balance on it. Now, one of the differences here is that in a cash balance plan, there are two different ways that a participant's balance increases. One is the pay credit, and that's defined in the plan document, and typically that's a percentage of pay or a flat dollar amount. What I've shown here is that the pay credit is just set at a $100,000 flat amount. And then the second way that it grows is with the interest credits. And the interest credit, that is also defined in the plan document. And as an example, sometimes that's the 30-year treasury, or we'll use that 30-year treasury with a 4% floor. Those aren't the only options, but that is another way that the account balance for the participant grows in the cash balance plan. So then here, I'm just kind of showing you, I'm taking a few years of growth for this particular participant. On the previous slide, I said, hey, the pay credit for this participant is equal to a flat $100,000. And then here we're using a flat 4% interest credit. And so as we walk through the numbers, for the first year of the plan, here we're assuming that 2017 is the first year of the plan. And so all that the participant receives is $100,000. And they receive that at the end of the year so that there's no interest credit in the first year of the plan. So at the end of 2017, they're sitting at $100,000. Then we go into year 2 in 2018, and again, the participant receives a $100,000 pay credit, and then they also have their balance heading into 2018 grows by 4% or $4,000. And so at the end of 2018, we add all those numbers up and we're at $204,000. And so then finally in year 3, the pay credit again is that flat $100,000 amount. It grows by 4%, that balance heading into 2019. And so at the end of 2019, the participant would have a hypothetical account balance equal to $312,160. But again, just to point out, we are defining what that pay credit is and what that interest crediting rate is that we're going to use those are both defined in the plan document, and we're kind of getting at that defined benefit plan that a cash balance plan is. All right, you might have noticed, and you might have had a question on the previous slide, why are we using this hypothetical account balance rather than just, call it the account balance itself? Well, with the cash balance plan, all of the contributions are, one, made by the employer, and two, they're all made to a pooled account. So, from an advisor perspective, when you're opening up the cash balance plan account, you will simply open up a single account that will house all of the contributions and earnings in that one account. And that one account, when the plan ultimately terminates, all the money that's accumulated in that one account will be used to pay out all of the participants. The plan assets are trustee directed. So that is, the employer bears the investment risk for how the assets are invested in the cash balance plan. We've talked about this a little bit, but the interest crediting rate, I used a 4% in the previous slide's example. That really becomes the target return for the plan assets. One of the unique features of a cash balance plan is that the plan assets at any given time, they may be worth less than the hypothetical account balance, and vice versa. At any point in time, the plan assets may be worth more. And in the next couple slides, we'll look at a couple of examples just to illustrate that point. And finally, every year there is a contribution range. So one of the things that we'll do as the plan's third-party administrator or actuary is we will calculate what the minimum required contribution is for the plan and also the maximum deductible contribution for the plan. And, again, that's one of the unique features, but it also provides the business owner with some flexibility depending on if they had a really good year, they might want to put the maximum deductible contribution is, or what that amount was, they contribute that. And in a down year, they may just be putting in the minimum required contribution. So let's take a look here, comparing the value of the plan assets versus the actual total hypothetical account balances. So on the left, I've shown, we've assumed that we have 3 participants, and we can think about this as, say, three owners, and each of the 3 participants have a $204,000 hypothetical account balance at the end of 2018. So in total, the hypothetical account balances equal $612,000. That's what we've shown on the left. Then on the right shows, or is supposed to represent, the value of the plan assets that are actually in the brokerage account or in the trust. And so we've assumed that at the end of 2018, the market value of those cash balance plan assets is $550,000. So if we compare the two, the $612,000 in hypothetical account balances and the market value of plan assets, we actually have a shortfall of $62,000 in this plan at the end of 2018. And from a valuation perspective, or what the business owner is responsible to contribute to make up that shortfall is actually amortized over a period of 7 years. So it's not something that the business owner has to make up all at one time. They actually have time to make it up depending on how much money they have that particular year to contribute to the plan. Now, I also like to look on the other side. Here we've assumed, so same hypothetical account balance total of $612,000, but now we've shown that the market value of plan assets on the right is worth $660,000. So again, if we do that comparison, we actually have more assets in the plan than we need at the end of 2018 if we were going to pay all the participants out. So here we've got an excess of $48,000 at the end of 2018, and that's not a problem. But that I just wanted to illustrate the point that, you know, at some points the value of the assets might be less than the hypothetical account balances, and at some points the value of the assets might be more than the hypothetical account balances. And with that, we'll hop into
one question on that.
Oh, yep.
One of the questions is, can the shortfall be made right away, and is it deductible?
Yeah, good question. So if we're dealing with that $62,000 shortfall, yes, as long as the total contribution for that year falls within that contribution range that we were talking about, you know, on this previous slide, that last bullet. As long as the contribution falls within that contribution range, it's totally fine for them to make up that shortfall all at one time.
And may I jump in here for one second? For our clients that we work with on their cash balance plans, we typically we give them the range of the minimum to the maximum, but we also tell them, here's the amount that we recommend you fund so that you get the plan back to 100% funded. So what we're trying to do is manage the shortfalls and the excesses on an annual basis. Our clients don't always take our advice, but we do tell them what they need to make in order to get to 100%.
Any other questions there, Alex, on that?
Just one more. What happens if the business is unable to make up a shortfall? So, for example, if the business has declined?
Yeah, so that again goes back to, and it is an important point. And since we just passed the 9/15 deadline, that minimum required contribution is due by September 15th. And so, you know, the shortfall, yes, is going to come into the ultimate calculation of what the contribution range is for the year. If the business does not have the money to make that minimum required contribution, what happens is that there's a 10% excise tax that applies on any unpaid minimum. So the shortfall is a part of that minimum required contribution calculation, but at the end of the day, what happens to the business owner is that if they can't make that minimum, a 10% excise tax applies to any unpaid minimum. And there's a Form 5330 filing that also needs to be filed to report that unpaid amount.
Awesome. Thanks, Jeremy.
Yep. All right, so with that, we'll go to our next poll question. How confident are you in identifying clients who would be candidates for a cash balance plan?
It looks like we've got the heavy majority, about 60% saying somewhat.
All right, good enough. Yeah, I'm always curious just to take a temperature to see, you know, because one of the big things here is, hey, getting comfortable with who would make a good candidate for a cash balance plan, and if in doubt, you know, reaching out to us to kind of talk through the situation, and we can talk through whether we think it would be a good candidate for a cash balance plan or not. So then we can hop into, what are some characteristics of the good candidates for cash balance plans? And that top one, might be an obvious one, but sometimes, or a conversation that comes up, hey, I'm maxing out my 401k plan contributions. Is there anything else that I can do to contribute more? And so, for those that are already maxing out or have the desire to contribute more to retirement plans, cash balance plans might be a good fit for them. That second point, companies with steady cash flows tend to be good candidates for them, provided they have the interest and the money to contribute more to retirement plans. The steady cash flows make it a little easier year to year determining what that contribution range is going to be. In general, companies with older owners, and this goes back to one of the previous slides with the limits, I had talked about how as the business owner gets older, their limit for the cash balance plan increases. And so they have more reasons to contribute to a cash balance plan because their limits are higher. That's not to say that you might not want to look at a business owner that's 35 or 40. It might still make sense depending on their particular case or characteristics. But in general, older owners are going to be better candidates for cash balance plans. That next point, it's important for the owners, if they have employees and we're in a tested situation, where we have to do non-discrimination testing, there is a pay-to-play element. Similar to a 401k plan, where if the business owner wants to max out what they're doing for themselves, they have to be willing to make contributions for their employees in order to pass non-discrimination testing. And then this goes back to one of our original poll questions, but a vast majority of these companies who sponsor a cash balance plan have less than 100 employees, and even more so less than 25 employees. All right, next poll question. True or false? A cash balance plan and or qualified retirement plans can help business owners qualify for the 20% pass-through deduction.
All right, it looks like the overwhelming majority, about 90%, say true.
Excellent. All right, yes, that is a true statement. And we're going to get into, how cash balance plans and tax reform, for some business owners, they even have more reason to put a cash balance plan in place to help them qualify for that pass-through deduction. Now, I will state clearly, full disclosure, I am not a CPA, and so, with this 199 cap A deduction and the qualified business income, consult your client CPAs on, to really dig into the Section 199 cap A deductions. But in general, conceptually, we kind of want to set up how a cash balance plan can be used or give business owners more reason to put a cash balance plan in place. And so the first point here, the deduction, so this 199 cap A deduction phases out for those in a specified service trade or business at $157,500 for single taxpayers and $315,000 for joint taxpayers. And so what happens is that we can kind of group those that own a business, these taxpayers, post-tax reform, we can group them into these four categories. So at the top, you've got the extremely high earners where even if they put a cash balance plan in place, they're going to end up being above that phase out range and not be eligible for that 199 Cap A deduction. Then in the next box down, you have those that have an income that's above the phase out, and potentially, depending on how big a contribution we can get them, we might be able to get them either into that phase out range where they qualify for some of that 199 Cap A deduction, and even potentially below the threshold where they would qualify for the additional deduction. The next box, those that are in the phase out range, if we put, and it doesn't necessarily have to be a cash balance plan, but if they put a retirement plan in place and they use that contribution to get them below the threshold, what we're conceptually driving at here is that retirement plans can be used, not only are they getting that dollar for dollar deduction on the contributions made to the retirement plans, but now they might also qualify for themselves for the additional 20% pass-through deduction. So those, there is a group of business owners that have even more reason to put retirement plans in place post-tax reform versus pre-tax reform. And we're just going to walk through a few basic examples to try and drive home this point. So the first example here, you have a taxpayer that's under the income threshold for the 199 Cap A deduction. And so without the plan, so we're assuming that we have a sole proprietor that's married, filing a joint return, and the income is from practicing law. So this would be a specified service, trade, or business. So those income phase outs apply to them. And so we just wanted to talk through how this looks. So without the plan, we're assuming that their taxable income is $250,000 and they make no 401k plan contribution. And so their qualified business income remains at $250,000. And because they're under the income threshold for a married joint return, they get that 199 Cap A deduction of 20% of the $250,000 or $50,000, and so their final taxable income is $200,000. Now, if they put a 401k plan in place and they, assuming they max out their 401k plan contributions of $56,000, that reduces their qualified business income to $194,000. And so the $194,000 is what they'd receive the 20% pass-through deduction on. And so now their 199 Cap A deduction is at $38,800, and their final taxable income is $155,200. Now, one of the things that might come out of this is essentially the same example that we just walked through, but that particular, or this particular sole proprietor might have more reason to, instead of making their deferrals on a pre-tax basis, they make their deferrals on an after-tax, or make their Roth deferrals. And so that keeps their qualified business income, it doesn't reduce it as much, because they know they're still going to receive the 199 Cap A deduction on what's left after they make their profit sharing contributions to the 401k plan. And so just something to point out there, that some business owners might have more incentive to make Roth deferrals and put some money in that after-tax bucket post-tax reform. All right, so this second example, now we've, instead of $250,000, now we've assumed that this sole proprietor that's practicing law is earning $450,000. So now they're above the income phase out of $315,000. And so without the plan, if they don't put a 401k plan or a cash balance plan in place, well, then their qualified business income is too high, and so they don't qualify for the 199 Cap A deduction, and so their final taxable income is $450,000. But if they put a 401k plan and a cash balance plan in place, and here we've assumed that we can get them $150,000 in tax deductible contributions. Now that allows them to get their qualified business income below the $315,000 income threshold, and so that helps them qualify for the 199 Cap A deduction. And so here's an example where it's the ideal situation where the business owner has 60,000 more reasons to put a cash balance plan, 401k and cash balance plan in place to help them qualify for those additional deductions. And then finally, here I've included, again, we're just building on that first example, but we've assumed that the sole proprietor is making $750,000 in taxable income. And so now we've got an extremely high earner that's well above the income threshold. And so even if we were able to get them $250,000 in tax deductible contributions, we're not able to get them below the income threshold in order for them to qualify for that 199 Cap A deduction. Now, that doesn't mean that they don't still want to put a cash balance plan in place. They'd still realize the tax deduction on the $250,000 in contributions that they're making to the plans. It's just they don't get that additional kicker of the pass-through deduction. All right, so final poll question. True or false, a cash balance plan works best when you have younger owners and older employees?
It looks like we have 95% saying false.
Excellent. Great answer. Yeah, that is true. So ideally, the opposite is going to be true. It works best when we have older owners and younger employees. And for those that do a lot of 401k plan business and might not work with cash balance plans, from a testing perspective, it still works best when you have older owners and younger employees in a 401k plan. So the same is true, when we add that cash balance plan to an existing 401k plan. All right, so just have a couple more examples to walk through as we wrap up the webinar. So example 4, here we're showing a cash balance plan where we have 2 owners and 2 employees. And you can see the demographics here, 58-year-old owner, 46-year-old owner, and then we do have the younger employees. So from a census perspective, that makes the results look nicer. And I don't know if I'm going to walk through all the specific numbers here, but what I want to point out is, we've assumed owner 1 and owner 2 both make $250,000. And between the 401k, the safe harbor contributions, the profit sharing, and the cash balance, owner number 1 is able to contribute $187,000 to the 2 plans. And owner number 2 is able to contribute $181,000 to the 2 plans. Now, the $6,000 difference, just the $6,000 in catch-up contributions that owner 1 is eligible to make and owner 2 is not. But then, the question becomes, well, what is required to be given to the employees in order for the two owners to receive these high contribution totals? Well, the employees, and I've put it in the summary below there, the employees must receive 7.1% if we add up the safe harbor and the profit sharing contribution, and then 2.25% cash balance contribution in order for the two plans to work together nicely and for us to pass non-discrimination testing. So in total, not a huge cost in terms of what they have to contribute to their employees in order for the two owners to get these large tax-deductible contributions for themselves. But it is a question, just to highlight it, it is a question that comes up. Business owners will ask, whether it's the advisor or the client themselves, hey, in my plan document, it says that my profit sharing contributions are discretionary. What gives? Why do I have to make the profit sharing contributions? And the response there is, if they're going to pass non-discrimination testing, they are going to need to make a profit sharing contribution. So we, as the third-party administrator for the cash balance plan and the one that's doing the combined plan testing, we're going to minimize what that profit sharing contribution has to be, but it is important for the business owner to know that they will need to make a profit sharing contribution in order for all this to work. So you might be wondering, what's needed in order to put a cash balance plan design together? And we've just listed what we need in order to do that. But it's essentially the census information that you'd need to gather for a 401k plan design. Well, we're going to need that same information for the cash balance. And so dates of birth, dates of hire, what they're projected to make in 2019 and how many hours they're going to work, 1,000 hours being the magic number there. If there is an existing 401k plan, we'll need to know the deferral amounts. And then it's best to actually have a copy of the adoption agreement in order for us to make sure that the two plans will play nicely together. And then the entity type, we just want to know, are we dealing with self-employment income for the business owner, or are we dealing with W-2 wages? And then what the business does. So that's the information that we need in order to do our thing and give you a design that you can present to your clients and or prospects. From an implementation perspective, really it starts with identifying the client or prospect. We talked a little bit about good candidates for a cash balance plan. So if you think about your book of business and some clients that might be a good fit for a cash balance plan, identifying them obviously is the first step. And then, if you have questions about it, call us to discuss their situation and see, hey, do you think it's worth us to present a cash balance plan to them? And then if we decide that, let's move forward and prepare that initial design, then, that's when we'd need to collect the census information and find out the existing retirement plan, whether it's a 401k or some other, or if they have a SEP. We just need to know, what they currently have in place. You send us the census information, and really you can route that through Alex because we work a lot together with Alex and RPC to put these designs together. We prepare that plan design at no cost. And once we've prepared the design, we're happy to participate on a conference call to discuss any questions that come up with the design itself with your client or prospect. And then if they decide to move forward with it, then we finalize that design, and finally we're preparing the plan document for the client to sign it and to formally establish the plan. So that's the process in a nutshell for getting a cash balance plan in place. In terms of what we do, with respect to the cash balance plan, we prepare an actuarial valuation report every year. That's something that has to be done for the administration of the plan. We determine the final contribution amounts that are needed to pass testing, both on the cash balance side and on the 401k plan side. We prepare annual participant statements that show what each participant has in the cash balance plan. And then we prepare the annual Form 5500 filing. And if needed, if sometimes the cash balance plans are covered by what's known as the Pension Benefit Guaranty Corporation. And so if that's true for the client, we will also prepare the PBGC filing. And finally, we maintain the plan document, recommend any design changes, as the employer demographics change for the business. And so that's really what we're doing on an annual basis to administer the cash balance plan. So here, we just wanted to highlight a real client case study. At the beginning of the presentation, I talked about the big opportunity associated with the cash balance plan is that it gives the business owner the opportunity to accumulate $2.9 million in it on a tax-deferred basis. Now, the business owner doesn't necessarily have to accumulate $2.9 million. I've worked with a number of clients that have reached that maximum lump sum, and they've rolled over the maximum lump sum either into their 401k plan or their traditional IRA, and awesome. Great result. $2.9 million really helps them, feel prepared for their upcoming retirement. But it doesn't have to end in $2.9 million. Maybe they only want to accumulate $1 million in the cash balance plan. We can scale it to meet your client's needs. So just something I wanted to point out there. With this real client case study, we have Dr. Carlson. And Dr. Carlson has a dental practice, and they set up a 401k plan and a cash balance plan back in 2008. His wife, Kathy, also works for the practice and receives contributions in both plans. There are 6 active employees that have incomes ranging from $30,000 to $50,000 a year. The plan has a safe harbor feature in the 401k plan so that the doctor and Kathy can maximize their deferrals. And then, just to note, there are combined plan deduction limitations that come into play that reduce the profit sharing contributions for Dr. Carlson and Kathy. Because that's another question that comes up. Why can I no longer do 25% of pay and it's only 6%? Well, there are combined plan deduction limits that come into play as we have these plans playing together. So from an annual contribution perspective, this is what 2018 looked like for them. But the thing to highlight, a bunch of numbers on here. Dr. Carlson and Kathy were able to contribute $219,000 for themselves, and the employees, they had to contribute $19,000 for their employees. So 92% of the total contributions went to Dr. Carlson and Kathy, with 8% going to the employees. A great result, but just a specific example of how 2018 played out. And so with the next slide being, hey, where are they after 10 years of having these plans in place? Well, in total, they've accumulated $2,357,000 in the 2 plans. And so again, we haven't gotten them all the way to that $2.9 million mark, but it's still a great result, and it's helped them reduce their current tax liabilities every year and also help them prepare for retirement. So quickly, from an investment strategy perspective, as you think about advisors, how are these plan assets invested? And this is just kind of, scratching the surface. If you have questions about it, happy to have discussions more about this. But again, Typically, maintaining the tax deduction is the primary goal for these cash balance plan assets. As we talked about, the investments are pooled, so there's no participant self-direction. The plan sponsor and the business owner bears the investment risk for the assets in the plan. And then the plan guarantees an annual rate of interest, and that's called the plan's interest crediting rate. And I've listed a few more examples there, but 30-year Treasury can be used, a flat 4%, a flat 5%, a flat 6%. It really depends on what we're trying to accomplish. If there are employees in the mix and we have to pass non-discrimination testing, but those are some basics as to, that interest crediting rate really becomes the advisor's bogey for what you're trying to get in terms of how the assets are invested in the plan. So your role as the advisor, you want to determine an appropriate investment strategy. So taking into account that interest crediting rate, and then also what the owner wants to do from a funding or contribution perspective. We want you to be involved when we're putting together those projections or the final contribution amounts year to year. So to make sure that these deposits are being made timely and the deadlines are being met. And then on an ongoing basis, that we're all in conversation to make sure that the business owner's needs and goals are being met. Quickly, from an upcoming retirement plan deadline perspective, the 9/15 deadline we already talked about, but that is when DB plan minimum required contributions are due. September 30th, last day to set up a Safe Harbor 401k plan. October 15th, if clients have extended their 5500s, the Form 5500s are due. November 1st, sometimes this is a gotcha. We have a great candidate that they want to put a 401k plan and cash balance plan in place for the current year, but what do you know? They have a simple plan, and so they actually have to wait until the following year to put the 401k plan and cash balance plan in place because they need to make sure they notify their employees at least 60 days in advance that the simple will be terminating at the end of the year. And then from as we head into the fourth quarter gets really busy from a new retirement plan sales perspective. That's when things really ramp up for us and maybe for you as you're talking to your business owners and about their tax situation or retirement situation. And so the last day to sign a plan document to establish a new retirement plan for 2019 is December 31st. And finally, to wrap up, key takeaways. So retirement plans continue to be a big opportunity for business owners. Some business owners, as we talked about earlier, have even more incentive to put retirement plans in place post-tax reform. And then, it's important to be in conversation and to be meeting with clients to understand the full impact of how tax reform impacts their individual situations and, potentially how retirement plans can help them out. So with that, thank you for joining us today. We appreciate your time. Hopefully you've learned something new. And if you have any specific questions, you can let Alex know and contact us directly. We're happy to answer those cash balance plan related questions, and we want to help you grow your retirement plan business. So thanks again. Alex, I'll kick it back to you.
Thanks, Jeremy. Thanks to everybody for attending today. I know that there were a few questions that came in here at the end that unfortunately we're running up against the hour. So our regional directors will actually reach out to each of you directly to ensure that those questions get answered. But of course, if you have any questions in the meantime, feel free to reach out to them or myself, and we'll be able to connect you with Jeremy as well. All right. Thanks for everybody.
Thanks, Alex.